Antigoni Polychroniadou, and she's going to be talking about Atlas X equity financing. I'm fascinated to find out what that is. So let's welcome Antigoni to the stage.
Thank you, Kenny. Today I'm going to talk about Atlas X, which is a product we have developed at JP Morgan. First, I'm going to introduce some financial terms to understand the use case. Then I'm going to talk about the challenges for the solution. Then I will only skim like super high level of the solution. And then I'll conclude with some experiments. So first, some financial terms. So when we say that the market is bullish, it means that the stock prices are going up. Investors invest a lot. And in general, there are positive news in the market. On the other side, we have the bearish market when the prices are falling down, then there's not a lot of trading activity, and there are bad news and we have weak economy. So the best strategy that you can do when we are in a bullish market is what is long exposure. Okay, so what do you do here? You borrow some cash, you buy a stock, and then you keep it because you hope that the price will increase more, and then you will get more money, okay? Then you can also make money when the prices are going down, and this is what is called short exposure, okay? So here, what you can do, you can borrow an asset, then sell it, and then repurchase it again when the price is going down, okay? So you are betting that the price of a stock will go down. Let me give an example here. So let's say you want to buy Tesla stock. So let's say you borrow Tesla when it is, I don't know, at $250. Okay, so you borrow it, you sell it at 250, and then you buy it back when it is 200. Okay, so you made actually $50 per share. So that's how this strategy works, okay? It's a little bit convoluted, but that's how this strategy works. And now if you want to either get a long exposure or a short exposure, you go to a brokerage, and JP Morgan is one of them. And ideally, what you would like to do, you would like to have the same long and short exposure, because if we go back, you have to borrow cash or borrow the asset. So you need to have like funding rate and borrowing rate. So you need to account for all of this. So if I can equate them, I don't have to bear these costs, okay? So I reduce the risk. And this is what is called internalization. I have an example here. So let's say we have stock A from different desks. It's not important for the talk to understand what desks these trades come from. And let's say we have 300 shares for long and 100 shares for short, okay? So we can actually match 100 and we are left with 200, okay? And then another match we can do here, we have 300 long and 300 short, we can completely match them, okay? So we have 0 left. And here I have like the summary. For example, we can really like match all of these quantities, but we are still left with some net difference, okay? So internalization is great when we want to actually reduce our risk and not go outside of the market. So if somebody comes to us and says, I want to buy the stocks, we need to go find them, right? But if we can equalize the long and short, we don't have to do that, okay? So this is the benefit of internalization, but we still have some left, okay? We would really like to equalize our long and short exposure. And usually how you can do that, as I said earlier, I hinted earlier, you can go actually to another bank, buy the shares and sell them, okay? So you need to go find them and you pay a fee. But if we still keep doing this internally, so we don't have to go to the market or to another bank, as I have it here, so we find the client that they want to do what we want them to do so that we equalize our long and short exposures, we don't pay any fee, okay? So what do we want? So this list that I had here, what we have left, how all brokerages are doing it now, they publish this list to their clients. And clients here are hedge funds, okay? They're big companies. So they publish this list. And then the client sees from this list what we have, and they come and trade against it, okay? And we hope that from this list, we will be able to internalize more, okay? So ideally, what we want to publish this list, and we do actually. And then the clients come and trade. However, there was a big concern and multiple clients came to us and complained. So if a stock is maintained by usually one client, it's called concentrated client. If more than 50% of a stock belongs to a single client, then they have these concerns that even if this aggregation is between multiple clients, as you see here, and here I have that client A has more than 50% of this stock, and stock B, another client has more than 50%. Uh, uh, from leakage and also from regulatory requirements, you're supposed to reveal some information. So they're saying even if this list is anonymous, you can still reveal our trading activity with you. So we want you to remove our positions with us, okay? So if we remove this, then we cannot really achieve this internalization and we have higher risk, okay? And just to give the problem in a more generic way here, so think that we have here 30 days, and now we have like the aggregated positions, they're moving like this in 30 days, okay? So here, minus is for sell, okay? So here you're selling, here you're actually buying, so this is the plot that we have. And we have a concentrated client, and this concentrated client holds most of this position. So you see that the green line really follows the blue line, okay? So they go together. So we want to hide this information. If a client is concentrated, we want to hide his trading activity. We don't want to show that he's actually the big holder of the stock, okay? And in general, if you think about it, so this is about buying and selling. So if you didn't understand my introduction, think that we want to buy and sell and we want to match that, okay? Think like that. And there are a bunch of techniques that we can use. The main one that comes to the head is secure multi-party computation. So we can hide what we want to actually offer and also what they want to do. They also encrypt it and then we can match it. And this is actually exactly what we did. We have another product called Prime Match, which is exactly this. So we have the bank's inventory and the client's inventory and we want to match it. And for example, here, I have this example, the client wants to go short 100 and the bank has for long 800, so we can match 100. And nobody knows anything else about the 100, okay? We will not know that at the end of the day, the bank is left with 700, okay? So you could think, okay, let's apply this to this problem. And this is how they came to me, because they knew about the primats and they wanted to apply primats to this use case. But actually, this use case is much simpler. So you don't need to hide all the information. And I have the analogy here with differential privacy. So with differential privacy, you are only hiding a specific information about your data. For example, here I have this picture. So you don't want to hide how many people are in the room, but you want to hide their nationality. Okay, so that's why I made the pixels like that. So the solution that we're going to go for here is differential privacy, because as I said earlier, we want to hide the trading activity of the concentrated client, okay? So whether we have the positions of this concentrated client in the dataset or not, we should not be able to distinguish, and this is what you can get with differential privacy. And differential privacy is used actually a lot from a lot of different businesses. For example, Google is using it for federated learning. Wikipedia and other companies, they use it for telemetry purposes. Microsoft is using it for synthetic data. Actually, differential privacy in synthetic data is a big thing. Apple is using it to find the most popular emojis. I don't know why. And here, what we're going to do, we are applying differential privacy in the finance, okay? For the first time. And as I said earlier, we have two lists. We're going to remove, if you want to remove the client who holds most of these positions, you want to be able to not distinguish whether we keep these positions of the client or not, okay? And we are adding noise. So I'm gonna talk about the first big challenge here. The first big challenge is that this is a time series data. We publish them every day, okay? So if you keep adding noise and adding noise, okay, if you don't add it in a smart way, you're going to destroy all the utility of the data set, okay? At the end of the day, you will destroy all the utility. So this is the big challenge. So we had to come up with a new algorithm that also incorporate this continual observation of the data. And as I'm saying here, this is running live for 2 years now in Asia, Europe, and United States. It's a $1 billion business. And then, as I said, we have this new algorithm. And again, so the important thing here was that when you use differential privacy, you need to actually talk what is the utility, okay? What do we care to maintain while we're adding this noise? And we had to talk with the business, what do they think would be the right metric for that? And I'm gonna talk about the right metrics here that we discussed with the business. And given the solution, so we have maintained our clients, so they don't want now to remove their positions from this inventory. And also we give better pricing because we don't need to go to the markets to fill the orders, okay? So I'm gonna talk about more challenges now for the solution. As I said earlier, you need to decide what is the metric to use. So there's this epsilon parameter in differential privacy, which tells you how much utility you can get. So the higher the epsilon, the less noise that you're adding, and you want to maintain the utility. So you want to balance the two. And also to use differential privacy, there's another big issue here. You need to have a lot of data to use differential privacy. For example, after this, they also came to me to apply differential privacy for other use cases, but they didn't have a lot of data. So it's really important to have a lot of data. That's something that needs to be taken into account. And here, fortunately, we had a lot of data. And the metric that we are using here is something which is called privacy and loss. It's called P&L. So earlier I told you that you need to borrow the asset or borrow the cash to buy or sell. So you need to pay rates, okay, if you borrow money, of course. If you don't have the money and you borrow them, you need to pay rates. So I'm not gonna give you the equation of this P&L, but think that it depends on the borrowing fee and on the funding fee, okay? So we need to find an epsilon value for the differential privacy that has an acceptable P&L, that we're not losing money, okay? And also, we're also measuring the leakage probability. What is the probability when you're looking the time series to tell that the data of a concentrated client is there, okay? And also, to find out the right value of epsilon when we start the product, we needed to use historical data and go over them, like do a lot of experiments to find out what will be the right values of epsilon. I'm gonna talk briefly about this at the end. And there are even more challenges. For example, how do you set the sensitivity of the differential privacy? So we were able to do that. It's important to not make the sensitivity of the differential privacy depend on the data. So we were also able to do that. And then here I have an example of how the obfuscation looks like. What I call obfuscation is when we add the noise with differential privacy. So the blue line is the actual true data that we publish every day. The green one is the concentrated client. So you really see that the concentrated client holds some of most of this position because he really like drives this stock, okay? And now you can see with the orange one is after we add obfuscation. Okay, so and you know in differential privacy you need to have these spikes here, okay? So here is the number of shares and here is the timeline. We publish it every day. This is for 1 year, I think, yeah. So you see we have these spikes here, okay? And at the beginning they were telling me we don't want these spikes there. I mean, you cannot achieve differential privacy if you don't have the spikes there. So that was the big argument I had with them. And at the end, what we did, we calculated the P&L at those points, because imagine that we are saying that, let's say we only have 20 shares of Apple, and because of differential privacy, we are showing 1 million shares of Apple, okay, which we don't have. And they will see that, and they will come to ask for this 1 million shares, and we will not have them, okay? So that's what happens in the spikes. So we calculated how much would be our P&L for these cases, and based on what was acceptable for them, we decided on the parameters of the differential privacy, okay? And then the system integration here, to be honest, it was not very hard because differential privacy code and all of that, I mean, compared to secure multi-party computation, it's very simple. And then for regulations, we had to explain to them that what we are showing to the clients is not really what we have, because we're adding the noise here. So it was very weird for them, like, why do you publish this if you don't have it? And then we had to explain that this is the methodology and all of that, because you need to report to the regulators how much you have. And they were seeing actually the difference. At the beginning, when we launched the product, we had the problem, because they were saying, why you don't publish what you have? And we managed actually to tell them about the solution, and now they are okay with it. And then we also have to explain to these clients that they were complaining that this is the solution, we don't reveal your positions and all of that. That was yet another problem that we had to convince them. Okay, now I'm gonna give you a super high level of the solution, and I'm hiding too many details under the carpet here. I just only want to give you the idea behind this. So the naive approach is that, let's say we have 17 days here, and every day we have some numbers that we need to keep adding every day. So this is a simple summation example. It's not like the one we have that it can go up and down. So the naive solution you can do, every day you need to publish a number, you just keep adding independent noise every day, okay? First day this triangle means noise, okay? So every day we keep adding new and new noise, okay? New independent noise. So if you do that, then the error that you will get at the end is proportional to the number of time steps that you have, okay? Where delta here is the sensitivity of the differential privacy, for those of you who understand the sensitivity. So we want to do something better, okay? This is similar to the example I was showing you with the picture that if you keep adding independent noise, you will lose all the utility. So then another thing you can do is you can have a parameter called B, which I call a window. So what you can do a little bit more smarter, you can again keep adding noise, and then when you reach a multiple of 4, you actually forget about the previous noise and you sample new noise, okay? Then again, when you go to a multiple of 4, you delete everything else, and now you have only 2 noises, okay? You can keep doing that. And then at the end of the day, you can actually bring the error to t to the 1/4, okay, which is much better than having the error depending on the number of time steps. Okay, and then we have another algorithm where you can actually bring it down to log t. I'm not going to talk about that one, but think that you have a tree structure, and now how much noise you add is only like logarithmic, okay, in the number of time steps. I will go to the experiments. I will not explain that. So for the experiments, as I said, when we wanted to launch the product, we had to decide what is the epsilon parameter of the differential privacy. So we got the previous data they had for the full year, and we ran a Monte Carlo simulation in the following sense. So at the beginning, we have the historical data for 1 year, okay, and then we decided like, this is what you're supposed to publish every day, and then we added the noise, and then we published it. And now, because this is a simulation to decide, right, we had to decide how much the clients are going to consume, okay? Let's say they are consuming 15%. And then we are removing the 15%, and here is what we left, and this keeps going on. So this is how we did our simulation, to simulate 1 year of this product, how it would go, and to decide what parameters to put for the differential privacy. This is how we did it. Here first, I have an example on synthetic data. So you can see I have an example where a single client holds the data. So you can see with differential privacy, like how it moves. So in the short term, you are completely hiding the activity, but in the long term, you do follow the curve of the actual one. So it's important in the short term to hide the information. So these ones are based on real data. This is the stock. Of course, I cannot say which stock it is. But again, this is the number of days, and here's the number of shares. So again, you can see the true one is the real one. The green one is the concentrated client. You see, he really moves his strategy with the real one, and the orange one is the obfuscated with the differential privacy. This is for epsilon 0.6. For 0.3, it looks like that. I'm just flashing you the plots here. This is yet another stock, and this is yet again another stock. And then here I have, for different epsilon parameters of differential privacy, how much P&L we're going to lose, okay? Because I told you this is the metric to decide on the epsilon. So the epsilon that we put in production is 0.3. And for this one, we are actually losing $1 every day per asset for that one. And here, what I plot is like the P&L difference, whether in the obfuscated data we include the concentrated client and whether we don't include it. So when we don't include the client, we are losing $4. So it's good to include the client and obfuscate, because in that case, we save $4. And the last plots I have here is the leakage probability, how much we are revealing the concentrated client activity. So if you are close to 0.5, is that it's a guess. You cannot guess whether you are buying or selling. So you really want everything to appear in the middle, to be 0.4, okay? And for different parameters of epsilon here, you can see that when you don't add a lot of noise, you are not close to 0.5. But when you add more, you see most of the stocks are in 0.5. The y-axis was the number of stocks, okay? So to conclude, so we have this Atlas X, and think of it, it obfuscates time series data, and it runs in 3 regions. And we have a new algorithm. I didn't give you the details, just the idea of it. And then I gave you some of the challenges that we had with the business. And I want to say in general that using differential privacy, we can hide some particular information about the data set instead of just using full-fledged secure multi-party computation. But also the combination of differential privacy and secure multi-party computation can be beneficial. For example, there's this case, there are a lot of papers on what is called privacy-preserving dark pools. And the most efficient solution for one server is is super slow, okay? You cannot really use it for production. So here we have a new work where we combine it with differential privacy and secure multi-party computation, and the running time of this one is very close to the non-private one. So this is something that combining the two, you can actually make more efficient algorithms. Okay, thank you.